G. Cigar Butts and the Institutional Imperative. To quote Robert Benchley, having a dog teaches a boy fidelity, perseverance, and to turn around 3 times before lying down. Such are the shortcomings of experience. Nevertheless, it's a good idea to review past mistakes before committing new ones. So let's take a quick look at the last 25 years. My first mistake, of course, was in buying control of Berkshire. Though I knew its business, textile manufacturing, to be unpromising, I was enticed to buy because the price looked cheap. Stock purchases of that kind had proved unreasonably rewarding in my early years. Though, by the time Berkshire came along in 1965, I was becoming aware that the strategy was not ideal. If you buy a stock at a sufficiently low price, there will usually be some hiccup in the fortunes of the business that gives you a chance to unload at a decent profit, even though the long-term performance of the business may be terrible. I call this the cigar butt approach to investing. A cigar butt found on the street that has only 1 puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all profit. Unless you are a liquidator, that kind of approach to buying businesses is foolish. First, the original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. Never is there just one cockroach in the kitchen. Second, any initial advantage you secure will quickly be eroded by the low return that the business earns. For example, if you buy a business for $8 million that can be sold or liquidated for $10 million, and promptly take either course, you can realize a high return. But the investment will disappoint if the business is sold for $10 million in 10 years and in the interim has annually earned and distributed only a few % on cost. Time is the friend of the wonderful business, the enemy of the mediocre. You might think this principle is obvious, but I had to learn it the hard way. In fact, I had to learn it several times over. Shortly after purchasing Berkshire, I acquired a Baltimore department store, Hochschild-Kohn, buying through a company called Diversified Retailing that later merged with Berkshire. I bought at a substantial discount from book value, the people were first class, and the deal included some extras, unrecorded real estate values, and a significant LIFO inventory cushion. How could I miss? So, 3 years later, I was lucky to sell the business for about what I had paid. That leads right into a related lesson. Good jockeys will do well on good horses, but not on broken down nags. Both Berkshire's textile business and Hochschild-Kohn had able and honest people running them. The same managers employed in a business with good economic characteristics would have achieved fine records, but they were never going to make any progress while running in quicksand. I've said many times that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I just wish I hadn't been so energetic in creating examples. My behavior has matched that admitted by Mae West. I was Snow White, but I drifted. A further related lesson, easy does it. After 25 years of buying and supervising a great variety of businesses, Charlie and I have not learned how to solve difficult business problems. What we have learned is to avoid them. To the extent we have been successful, it is because we concentrated on identifying 1-foot hurdles that we could step over, rather than because we acquired any ability to clear 7-footers. The finding may seem unfair, but in both business and investments, it is usually far more profitable to simply stick with the easy and obvious than it is to resolve the difficult. On occasion, tough problems must be tackled. In other instances, a great investment opportunity occurs when a marvelous business encounters a one-time huge but solvable problem, as was the case many years ago back at both American Express and Geico. Overall, however, we've done better by avoiding dragons than by slaying them. My most surprising discovery, the overwhelming importance in business of an unseen force that we might call the institutional imperative. In business school, I was given no hint of the imperative's existence, and I did not intuitively understand it when I entered the business world. I thought then that decent, intelligent, and experienced managers would automatically make rational business decisions, but I learned over time that isn't so. Instead, rationality frequently wilts when the institutional imperative comes into play. For example, 1. as if governed by Newton's first law of motion, an institution will resist any change in its current direction. 2. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds. 3. Any business craving of the leader, however foolish, will be quickly supported by a detailed rate of return and strategic studies prepared by his troops. And 4. The behavior of peer companies, whether they are expanding, acquiring, settling executive compensation, or whatever, will be mindlessly imitated. Institutional dynamics, not venality or stupidity, set businesses on these courses, which are too often misguided. After making some expensive mistakes because I ignored the power of the imperative, I have tried to organize and manage Berkshire in ways that minimize its influence. Furthermore, Charlie and I have attempted to concentrate our investments in companies that appear alert to the problem. After some mistakes, I learned to go into business only with people whom I like, trust, and admire. As I noted before, this policy of itself will not ensure success. A second-class textile or department store company won't prosper simply because its managers are people that you would be pleased to see your children marry. However, an owner or investor can accomplish wonders if he manages to associate himself with such people in businesses that possess decent economic characteristics. Conversely, we do not wish to join with managers who lack admirable qualities, no matter how attractive the prospects of their business. We've never succeeded in making a good deal with a bad person. Some of my worst mistakes were not publicly visible. These were stock and business purchases whose virtues I understood and yet didn't make. It's no sin to miss a great opportunity outside one's area of competence, but I have passed on a couple of really big purchases that were served up to me on a platter and that I was fully capable of understanding. For Berkshire's shareholders, myself included, the cost of this thumb-sucking has been huge. Our consistently conservative financial policies may appear to have been a mistake, but in my view were not. In retrospect, it is clear that significantly higher, though still conventional leverage ratios at Berkshire would have produced considerably better returns on equity than the 23.8% we have actually averaged. Even in 1965, perhaps we could have judged there to be a 99% probability that higher leverage would lead to nothing but good. Correspondingly, we might have seen only a 1% chance that some shock factor, external or internal, would cause a conventional debt ratio to produce a result falling somewhere between contemporary anguish and default. We wouldn't have liked those 99-to-1 odds, and never will. A small chance of distress or disgrace cannot, in our view, be offset by a large chance of extra returns. If your actions are sensible, you are certain to get good results. In most such cases, leverage just moves things along faster. Charlie and I have never been in a big hurry. We enjoy the process far more than the proceeds, though we have learned to live with those also.